What is your biggest financial concern? Are you being as intentional with your finances as you could be? How confident are you that you'll reach your financial goals? How will life's transitions impact your financial plan? Welcome to the Clarity and Confidence for Life podcast with Tom Fleishel, founder, president, and CEO of Fleishel Financial Associates. Discover how we can help business owners, successful families, and corporate executives achieve clarity and confidence for life while providing tailored financial solutions that eliminate complexity and free you up to focus on what really matters in life to you and your family. Now, on to the show.
Hello and welcome to the Clarity and Confidence for Life podcast with your host, Tom Fleishel. I'm RJ Malik, producer of this podcast. Tom, how you doing?
Great, RJ. Thank you.
So, Tom, when it comes to giving to charities, I'm really unorganized. This is something that I know is a weakness of mine. If I have some bills and they're piling up, I pay attention to those, and then my charitable giving sort of gets put to the side. Is there a formula that I should be following as far as to be more consistent in my charitable givings?
There's no real formula. Every family's different. You just got to decide who is it that you feel like would benefit the most? Who do you want to give to? What organizations have you felt the most impactful in your life? And then come up with a amount and a strategy of how you want to give. I think it's certainly very flexible. You just be intentional and have a plan, I think, is really how it's going to benefit what you're trying to do.
Okay, so I need to really put down exactly what is important to me. And, for example, my college. I went to school, upstate school in upstate New York, I should say. We did not have the best relationship, but I played lacrosse in college and I loved my time playing lacrosse. So I donate to the lacrosse team, but I don't donate to the school because I have issues with them. Is that a good strategy, or there's no right or wrong to that? It's just how I feel.
No right or wrong. Again, everybody decides what are the most important goals and which should benefit, what organizations, what type of things have really made a difference in your life. And that's really what most people, it's a personal decision. It's certainly one that nobody can decide for you or anybody else what's appropriate. You guys have to come up with what's the best approach and who to give to.
Okay. Because I'm such an unorganized person when it comes to this, are there specific strategies that you can recommend for me to follow?
Well, there's all kinds of ways to give these days. You can just give right out of your budget each month and give to a certain charity. So much, you can do it that way. If you really want to get some distinct benefits and tax advantages, there's all kinds of different strategies that are out there, like one of the ones that have become more popular called a donor-advised fund. So the ultra-wealthy have these family foundations that are very expensive and very complicated, and they can donate gazillions of dollars to all these different charities, and they want their name on the building at their alma mater and all that kind of thing. But for those of us who are a little bit more realistic in life, they have this really easy way to do it called a donor-advised fund, DAF. Donate to any given year into this fund. You can set up with your financial institution. Usually the big banks and brokerage firms have these all set up and organized. And so when you make a contribution, you get the tax benefit that year. So for example, this year, if you want to give, let's say $10,000 or $15,000 in a lump sum, you make it into this fund, then the fund can be invested in different strategies for growth or income, however you want to set it up, just like in a 401k. You have all these different fund choices. And then later, down the road, 1 year, 2 year, 3 year, 5 years down the road, you can have that money distributed to the charities of your choice. So in the meantime, the funds grow tax deferred and, of course, come out tax free to the charities of your choice. So it's a great, easy, less expensive, less complicated way to make contributions through that strategy.
And that's called a donor-advised fund.
Correct.
Are there any other types of funds like that, or trusts or things that people have access to?
Another strategy that is really phenomenal, that's been around for quite some time, that people have taken advantage of. So let's suppose you have a highly appreciated piece of property, like a rental property, or a stock that you bought 20 years ago, and it now, you bought it at $10 a share. Now it's $150 a share. And You're like, oh my gosh, I've got all my money tied up in this one company stock, and what if it gets hit really bad? I am in trouble. So when you make big bets, you win big or lose big, right?
Right, yes.
So a way that you can avoid the problem with the capital gain, because if you sell it, you're going to have this huge capital gain, depending on your tax bracket, from all the way up to 20 to 23% on the high end. So that's reason a lot of people don't want to do anything. They just kind of sit and hope the best, the worst never happens with that stock or whatever, this property. So we set up a trust called a charitable remainder trust, CRT. You set up the trust, and then you transfer the stock or the deed of a property into the trust. You get a charitable deduction for up to 5 to 6 years by making that contribution. You spread out the capital gains for the rest of your life, and you get an income for both of your spouses' lifetimes off of that asset that now can be sold and diversified into a much more broad strategy, let's say, of kind of a moderate growth or income and growth strategy of all kinds of different stocks or ETFs or funds. And then you get this income for life. And then when you pass away, both of you are gone. The remainder of the trust goes to the charities of your choice. So it's a great way to avoid the capital gains, get a huge tax deduction, get an income for life, and then benefit charities down the road. Now, a lot of people say, well, geez, I want this money to go to my kids. I don't want to give this to a charity when I'm gone. Well, then if you're insurable, you can take out a life insurance policy that would pay out to somewhere equal to that asset. It would go tax-free to your heirs, and that also could be removed from your estate by using something called an irrevocable life insurance trust. So there's a lot of cool strategies out there, just depending on each client's situation and what they're trying to do.
Okay, so it's important to sit down then with your financial advisor to go over specific charities and what your goals are for when you're no longer around.
Absolutely.
Okay. Now, again, part of the theme of this podcast seems to be my unorganized donations. Explain to me what I'm missing as far as tax considerations.
Well, again, when you make a contribution to a charity, the best way to get the tax deduction is if you can itemize on your tax return. So The standard deductions are getting up there pretty high these days, especially for married couples. But suppose you have a windfall in a given year, you got this huge bonus, or you have some windfall of income, and you really want to get a huge tax deduction. You could front load your giving into a charity, some kind of charity for, it could last you for 3 or 4 or 5 years in terms of the benefit of doing this. But if you say, oh, geez, I had a $40,000 bonus and now I'm going to go ahead and contribute to something like this donor advised fund, and that you get the deduction on your tax return if you can itemize that year, which it might be the only year you could itemize, but that would be the huge benefit for doing that. But otherwise, if you have enough income and other deductions like mortgage interest, other taxes, property taxes that you might be paying, certain medical expenses to a certain degree of your adjusted gross income, but the charitable contributions are the biggest one. So those are the ones that you really have a lot of flexibility. You could give as much as you want, and that's going to really have an impact on your taxes. So each situation is different, so you just have to decide what works for you and your family.
Okay. Now, another issue that my wife and I have, we don't have children. So we haven't really done a good job of sitting down and talking about this, but we need to figure out what we're going to do with our house. We have a rental property. And again, like I said, we haven't had a real serious conversation about it. What are our options when you don't have children? We do have nieces and nephews, but we are looking at more than that.
Well, again, having a family conversation, sitting down together and deciding, what's important to both of us. If we were to pass away today, what's your wife's name?
Gina.
What charities would you like the money? Where would you feel like it would be the most meaningful to you for this money to go? And here's some of the ones that I think are important. So maybe we can come up with a plan. And that's what estate attorneys are really designed to do. You sit down with them, they come up with a plan. They're going to ask you these same kind of questions. What happens if either one of you are incapacitated? Who's in charge? What happens if you're both gone? Where does the money need to go? If there's heirs or children involved, how do they get the money all at once or stretched out over a period of time? And as I mentioned, I think it's important to really have these important conversations. When I was getting marital counseling with my wife, with our pastor, he said, guys, if you can talk about sex and money, you've got it made. So sitting down and having a conversation about these very important issues really is helpful. And that's what we kind of do with our clients. We sit down, the financial side of things, and try to pull out some of these things and have conversations, because it's not always easy as a couple alone to have these conversations. But if you have somebody that you really trust and work with, and they can facilitate these conversations, I think it makes it a lot easier to begin to discuss some of these plans and how do we want the money to go when we're gone.
So step one is to sit down with your spouse and talk about the future and your plans with your estate. Step two is then talking to your financial advisor, then a lawyer to put a will together, or have them both together, lawyer and financial advisor.
What we try to do is help prepare people to go see an estate attorney. We kind of have some initial questions that we know are going to be asked to get them thinking, because you don't want to have to, oh, geez, these are very important questions. If the attorney's sitting there and wanting you to get answers, if you haven't had a chance to process and think through those, it makes it more stressful and can be, we're just going to throw some stuff out there right now because we don't really know. Right. So it's better that you have some time to think through. And that's what we try to do with our clients, is to have a conversation. Here's, what has to happen when you're both gone, if you're incapacitated, all these types of things you begin to explore and talk about so that you have a little bit more time to process it when you actually have to go into an attorney's office and get it documented and then put the draft of the estate plan together. So I think that's helpful.
Okay, very good. So the theme that seems to be running throughout this podcast is planning is extremely important. And you need to sit down and incorporate a financial plan as far as what you want to do with your assets and with the remaining money. Am I understanding it correctly?
You got it. That's it.
You're teaching me.
If you plan to fail, don't fail to plan. So we want to make sure that we do have a plan in place. And again, it's a process. It's not an event. And you change your mind over time. And that's why we say about every 5 years, you probably want to dust it off. Make sure you get back with the estate attorney and review things and say, okay, well, this is how we felt 5 years ago. But you know what? Our situation's completely changed. We now have a health issue with one of us or whatever. So again, don't set it and forget it. Just like any other plan, you have to keep updating and making sure that it's consistent with your wishes now.
So every 5 years, or if a major issue, like a major health issue comes up, you should sit down and reevaluate your plan.
That's right. You might want to disinherit one of your kids,
For us, it's just nieces and nephews that we have to contend with. All right. So now let's go into the next phase of our life. We are done working, and do we change our strategy once we're retired as far as making charitable donations?
You don't have to change your strategy, but you now have more flexible options when it comes to things like your IRA, for example. So many investors, they've accumulated quite a bit of money. They might have had a 401k while they worked, and then they rolled it into an IRA when they retired. And now they're getting up into age where they're taking distributions out. And of course, that money was never taxed. So when you pull it out, it's all taxable. So you can make distributions out of your IRA through something called a qualified charitable distribution. And what that does, it's a direct contribution from your IRA that's coming directly from your financial institution, wherever you held it at, whether it's a brokerage firm or a bank or whatever. And the distributions from an IRA are typically taxable when taken out. But with a qualified charitable distribution, those distributions become tax-free as long as they're paid directly from the IRA to an eligible charitable organization. And for those who are at least 73 years old, we have now the required minimum distribution, which is based on your age and the account value at the end of each year. They do a calculation to determine how much you have to take out of your IRA and pay the tax. But now this qualified charitable distribution can count towards the IRA owner's required minimum distribution for that year. And so a married couple can donate up to $100,000 out of their IRA each. So $200,000 could be taken out and avoid taxes. And that's a much more tax efficient way to give rather than giving with after-tax dollars. Here, now you're avoiding all that taxable income. Think of how much $200,000 would save in taxes would have had to be subject to tax when it was pulled out.
Okay.
So this QCD option is really cool. It's a great strategy. Not as many people know about this. It's one that we try to help our clients look at once they get to that situation.
All right. So a financial advisor is really an important step. After you sit down with your spouse and you talk to your spouse and go over, things that you want to do with your future and donations and things like that, then the next step is sitting down with a person like yourself, correct?
Well, yeah. Some people that try to figure this all out themselves, God bless them if they want to try to do all that. But there's so many different things that have to be factored in, and the landscape changes constantly. So, hopefully you have a good, trusted professional relationship with someone that is really competent. They're on top of their game. They know the different rules and tax strategies, all the legal ways to avoid taxes. What's the difference between tax avoidance and tax evasion?
I don't know.
10 years in the federal pen. Tax avoidance is all that taking advantage of all the legal strategies that are available to us to minimize our tax hit.
Okay, so that's legal. That's legal. Okay.
Yeah.
Okay. All right, you scared me there for a second. Okay, I was like, okay, what am I going to face? Okay, very good. Now, philanthropy, and now this is probably something that I'm not going to really deal with, but I think it's a topic that I know you want to discuss, and it's important, especially to families who have had different generations, and and there's a lot of wealth involved. So can you go over that? Yeah, the challenges in turning personal wealth into generational wealth isn't only about dollars and cents, but it's about hearts and minds. So there's this thing called the third generation curse of wealth. In a well-organized phenomenon that often follows the pattern of wealth creation, there's growth and then loss because that third generation just doesn't appreciate all the sacrifices and all the difficulties that the earlier generations built this wealth, and they kind of blow it. They don't understand the value of money. They don't understand how to manage it effectively and responsibly. So it's so important that families have these conversations and discuss their values, their mission, why they do what they do, sharing these philanthropic decisions with their family members, even into the next generation, and especially the values, is going to really help facilitate a continuance of that wealth and make people more responsible. One of the things we do, we love having what we call a family summit. That's really a good communication with all the family members. That we get the parents in, maybe in the office. We'll Zoom in the kids that are across the country. We talk about their mission statement, their values, what's important to them, how, if they have a trust in place, for example, who's the successor trustee? Is it a family member? Is it going to be a corporate trustee? And just communicating what's supposed to happen. If I'm gone, Dad says, and Mom is incapacitated and she can't manage these affairs anymore, here's what next will happen. So you're all aware and you know who to call. So here's the financial team, here's the estate attorney, here's the tax person. So we want to make sure that everybody's aware what's going on and who to call in different situations. So all of those things are so important. We just, so many times it's tragic that we see families all of a sudden, okay, the last mom's gone, Dad's gone too, and here's the will. And guess what? We don't know who's supposed to do what or get what. And it's really, then there's all kinds of questions and strife and just really avoidable situations. If there's better communication, everybody's on board and knows what happens. We've got some great families that have done a great job at that. But like one of our most wealthy clients still probably didn't do as good of a job as they could have to communicate some of these things to the heirs. And so there's still kind of question marks as to what's going to happen and who gets what and all that. And it could cause a lot of problems. I have a personal experience with, on my mom's side, when my grandmother passed away, and she left the house and a little bit of money. But there was a fight between my mom and her one sister and brother. Her other sister was fine with it, but it caused such a problem that we did not talk to those two families for years. But fortunately there was a will, so everything was settled. But if there wasn't, that would have been a major issue. And that's why I think it's so important that we do communicate these things. And for all the legacy heirloom items that a family might have and acquired over the years, whether it's china or crystal or artwork or jewelry or just some silly things that really mean something to different members of the family, you can have an itemized list and who gets what. And that's all done ahead of time. For example, my father was a phenomenal artist. Right. He had several paintings that were just wonderful paintings that he was professionally trained. And he didn't really write on who was supposed to get what. So there was some disagreement about some of the paintings, some of the artwork. Yeah. And if that would have been laid out, we could have avoided that situation. So, yeah, that's the thing. All right. Very good, Tom. How can people contact you?
Well, they can contact us at FleishelFinancial.com, or they can Google us at Clarity and Confidence for Life. That's going to direct them right to our website, or call us at 386-738-1800.
Excellent. Appreciate it, Tom. Really, personally, for me, this was very educational. I thank you very much. And most importantly, thank you for listening to the Clarity and Confidence for Life podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Clarity and Confidence for Life, I'm RJ Malik, and we look forward to joining you for the next podcast.
Thank you for listening to the Clarity and Confidence for Life podcast. Click the subscribe button to be notified of new episodes when they become available. The information covered and posted represents the views and opinions of the hosts and/or guests, and does not necessarily represent the views or opinions of Raymond James. This content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional financial advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your individual situation. Securities are offered through Raymond James Financial Services Incorporated, member FINRA, and SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Fleishel Financial Associates is not a broker-dealer and is independent of Raymond James Financial Services.